Did you know there are over 33 million business owners in the United States? Many of them choose to structure their companies as limited liability companies, and it's easy to see why. LLCs offer flexibility, limited liability protection, and potential tax benefits. But here's the catch. Despite their popularity, many entrepreneurs don't fully understand the nuances of limited liability companies. I have worked with thousands of clients to set up their businesses. One common theme I've seen: people make mistakes, big ones. In this video, we'll break down the most common mistakes LLC owners make and how to avoid them. We'll also explore some key considerations that could save you thousands of dollars and countless headaches down the line. Whether you're already running a business or planning to start one, stick around. You won't want to miss this. Mistake 1. Not understanding the type of income you're earning. One of the first questions you should ask yourself before setting up an LLC is, what type of income will I earn? Why does this matter? Because different types of income have different tax implications, and the structure of your business should align with your financial goals. Let's break it down. 1. Ordinary income. This is income you actively earn from your efforts, like wages, business profits, or freelancing. Ordinary income is subject to federal, state, and self-employment taxes. For example, if you're running a consulting business or selling products, this income will be taxed as ordinary income. An LLC taxed as a sole proprietorship or partnership may not save you much on taxes unless you make the S-Corp election. In this scenario, some of your profits can be classified as distributions, which aren't subject to self-employment tax. 2. Passive income. Think rental income, royalties, or investments. Passive income is generally not subject to self-employment tax, making an LLC a popular choice for real estate investors. However, keep in mind that you'll still need to follow the right tax and legal protocols. For example, if you're earning rental income through an LLC, depreciation and other tax benefits can work to your advantage. 3. Portfolio income. This includes earnings from capital gains, dividends, or interest. If you're buying and selling stocks or other assets, you're dealing with portfolio income. LLCs are less common in this case, as individuals typically hold these investments in their personal names or trusts. By understanding the type of income you're earning, you can determine whether an LLC, S-Corp, or even a C-Corp is the best structure for your business. Mistake 2. Setting up an LLC after buying real estate. If you're investing in real estate, timing is critical. A common mistake is purchasing property in your personal name and then transferring it to an LLC. Here's why this approach is problematic. Privacy issues. Purchasing property in your name makes your personal information public. Establishing an LLC beforehand helps maintain privacy. Due on sale clause. Transferring property into an LLC may trigger this clause, letting the lender demand full repayment of the mortgage. Liability protection. LLC ownership separates personal assets from business liabilities, providing extra protection. To avoid these risks, set up your LLC before buying property. Consult a real estate attorney or tax professional for proper guidance. Mistake 3. Not using your employer identification number properly. Your EIN, employer identification number, isn't just a tax ID, it's a crucial tool for running your LLC. Common mistakes with EINs include mixing personal and business finances. Not using a business bank account tied to your EIN complicates taxes and exposes personal assets. Neglecting business credit. Your EIN is essential for building credit, which unlocks better financing options. Missing tax benefits. Programs like PPP loans required businesses to have clear financial records linked to their EIN. Even for single-member LLCs, use your EIN instead of your Social Security number for clients, vendors, or banks. Mistake 4. Ignoring required tax forms. Taxes are a significant part of LLC management, and errors can lead to penalties. Key forms include Schedule C, for single-member LLCs to report income and expenses, Form 1065 and K1, for multi-member LLCs to report income shares, SS4, form for obtaining your EIN W-9, form for independent contractors to share taxpayer info. Being proactive with taxes and consulting a CPA can save you time and money. Mistake 5. Not reimbursing yourself properly. Paying for business expenses out of pocket is common, but requires proper documentation to avoid issues. Here's how to reimburse yourself correctly. Set up an accountable plan. Create a policy requiring receipts and documentation. reimbursed from the business account. This keeps records clear and ensures tax deductibility. Proper reimbursement prevents loss deductions and promotes financial transparency. Additional LLC success tips. Choose the right state. Form your LLC in the state where you operate to avoid extra costs and compliance issues. Understand series LLCs. Useful for separating assets under one LLC, but not all states allow this structure. And last but not least, annual maintenance. File reports, pay fees, and maintain good standing with the Secretary of State. Final thoughts. Managing an LLC takes planning and attention to detail. Avoiding these common mistakes sets you up for long-term success. Like, share, and subscribe for more tips on building wealth and growing your business. Have questions? Drop them in the comments. I'd love to help. Thanks for watching, and I'll see you in the next video.